The biggest lie in self-directed pension management is that your portfolio must only consist of safe ETFs and low-risk, long-term stocks. Playing it completely safe guarantees three things: anemic returns, wasted tax benefits, and the ultimate nightmare, reaching retirement without enough capital to survive. Today, we break the safety illusion. We are opening the tactical segment of our portfolio architecture. I will show you how to execute high-conviction, short-term event trades inside your tax-free accounts without risking your foundation. What exactly is the tactical segment? It is a strictly quarantined allocation within your retirement portfolio. Because your tax-advantaged accounts shield you from capital gains tax, this is the exact place to execute high-conviction, short-term trades. You do not buy these assets to hold for 20 years. You buy them for a specific, imminent catalyst: an earnings report, a macro shift, a regulatory approval. So, what exactly goes into this bucket? We are not holding broad index funds here. We are targeting high-velocity assets, individual stocks pending FDA approvals, tech companies rolling out disruptive breakthroughs, or leveraged sector ETFs positioned for a sudden macro shift. We use these assets to buy the gap between the market's current perception and the coming reality. We buy the rumor, and we sell the news. But even in this high-velocity zone, we never gamble with the foundation. We apply two rigid structural constraints. First, this entire segment must never exceed 15% of your total portfolio allocation. Second, you never allocate more than 1% of your total portfolio to a single position. We cap the risk, not the upside. If that 1% initial investment goes to zero, your foundation doesn't even feel it. But if it multiplies, you let it run. The rule here is brutal, and it separates the architect from the gambler. The thesis is always, I own this only if X happens. Uncertainty is expected, but it is strictly limited by a deadline. If the catalyst fails to materialize, or the event passes without the expected result, you are out. Price movement does not matter here. Only the thesis matters. The deadliest trap in this bucket is emotional attachment. A tactical trade is a timed operation, not a marriage. The moment the original reason for buying disappears, the position must disappear with it. Never let a failed short-term trade infect your long-term retirement foundation. The moment you are right, you also execute the exit. We buy the rumor and sell the news. Once the catalyst is realized, we secure the gain and fold it back into our broader retirement framework. Before allocating a single dollar from your pension into this segment, you must ask the forcing question: what specific event or condition will trigger my immediate exit? If you cannot answer that clearly, you are not architecting your future. You are gambling with it. Stop wasting your tax advantages and stop gambling your retirement. Define the event. Execute, exit. Download the portfolio architecture framework below to structure your own tactical segment. Think like an architect. I'll see you in the next phase.